if you just retired and Medicare is charging you a surcharge based on your old high income, you are almost certainly overpaying right now. A retired couple whose income slips from just over $206,000 to $205,000 can cut their monthly Medicare surcharges by about $186,480 per month, more than $2,200 a year, simply by successfully appealing IRMAA with Social Security after their income drops. That extra charge is called IRMAA, and it is set using your tax data from 2 years ago, not what you earn today. So the whole trick is telling Social Security your income already dropped, and I'll walk you through exactly how. Here is why this matters. I read the fine print so you don't have to. For 2026, a married couple filing jointly with income above $408,000 pays a monthly IRMAA of $118.80 per person for Part B and $40.20 per person for Part D, which adds up to over $5,000 a year in surcharges alone versus standard premiums, according to SSA's 2026 figures. The catch is that IRMAA runs on a 2-year delay, so a big income year in your past keeps costing you long after you've retired. Step 1 is understanding the trap so you know you have a case. Medicare's income-related monthly adjustment amount is an extra charge added to your Part B and Part D premiums when your income from 2 years ago crosses certain thresholds, and Social Security uses IRS tax data to set it. If your income has since dropped because of retirement, work stoppage, divorce, or the death of a spouse, SSA keeps charging you the higher amount unless you formally ask them to fix it. Read your initial determination notice carefully. It shows the tax year they used and the income that triggered the surcharge. Let me put a number on doing nothing. Suppose a couple's 2024 income was $210,000, above the first joint threshold of $206,000, but their income after retirement drops to $150,000. Because Social Security still uses the old year, they pay roughly $164.60 a month across both partners, which works out to about $1,175 a year in extra premiums until the record is corrected, based on SSA's 2026 brackets. That is money leaving your pocket every single month for a snapshot of income you no longer earn. Step 2 is the main move, and it's one form. Retirement or work stoppage is one of 7 qualifying life-changing events that Social Security recognizes to lower IRMAA when your income drops substantially. You use Form SSA 44, the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form, which you download for free from ssa.gov. On it, you'll pick your qualifying event, enter the tax year SSA used, your old income and tax-exempt interest, and then your new lower income estimate for the current year. And you sign it under penalty of perjury, so be accurate. Step 3 is proving it. Because a bare form gets rejected, gather documentation that matches your specific event, a retirement letter or final pay stubs if you stopped working, a death certificate if your spouse passed, or a divorce decree if that's what changed your income. Also, bring your most recent tax return or a clear estimate of your new income for the current year. The stronger and more specific your paperwork, the smoother and faster the decision tends to go. Step 4 is getting it in and tracking it. Submit your completed Form SSA 44, along with your supporting documents to your local Social Security office by mail, fax, or in person. And always keep copies of everything you send. Reconsiderations are typically processed in about 30 to 90 days, according to advisory sources, though that timeline can vary with SSA's workload. A successful appeal shows up as a decision notice reducing or eliminating your IRMAA, and it can be retroactive, meaning you may get refunds for the months you overpaid. Here's the part people don't realize. Appeals can pay you back. Because IRMAA reconsiderations can be retroactive to the start of your surcharge or the life-changing event, successful appeals often generate refunds for overpaid premiums. If you were overpaying roughly $82.30 a month for 6 months before approval, that's a refund of about $493.80 based on SSA's 2026 figures, on top of stopping the charge going forward. Filing promptly recovers past overpayments and prevents future ones. Before I get to the smartest long-term move, the one that keeps this from ever happening again, here's what to do if Social Security says no. First, review the reconsideration decision letter and confirm the income year and bracket they used. If it's still wrong or denied, you can request a hearing with the HHS Office of Medicare Hearings and Appeals, then escalate to the Medicare Appeals Council and ultimately to federal district court if needed. If this walkthrough is useful, subscribe. The next breakdown is already coming. Now the most counterintuitive piece, and the most valuable. Winning your appeal fixes this year, but the real win is never triggering IRMAA again. Review the thresholds for your filing status and compare them to your projected income 2 years out, including Social Security, pension, and any IRA or 401k withdrawals. Then time large events like Roth conversions or capital gains carefully, because a single big year can push you over a threshold and cost you again 2 years later. Check your filed return against the brackets every year, so your surcharge stays at 0. Here's the stakes over a full retirement. A retiree who avoids roughly $1,000 a year in unnecessary surcharges and then keeps income below the thresholds can save that amount year after year. Over 10 or more years, invested at a modest 4% real return, those avoided surcharges could grow to more than $12,000 in additional retirement assets, based on a modeled estimate rather than a guaranteed figure. One form and a little planning genuinely add up to real money. Let's cover the mistakes that quietly cost people thousands. The biggest is believing the myth that once Social Security sets your IRMAA, you're stuck with it until new tax data arrives. That's false, because SSA and HHS explicitly give you the right to appeal after a major life-changing event using Form SSA 44. The second mistake is filing that form without documentation, which gets it bounced. And the third is winning the appeal, but ignoring the future. Letting a Roth conversion or big withdrawal spike your income and re-trigger IRMAA 2 years down the line. Let's run the whole thing back fast. Read your initial determination notice and confirm your income actually dropped. Then file Form SSA 44 from ssa.gov and gather proof of your qualifying life-changing event. Submit it to your local Social Security office. Track the decision over 30 to 90 days and escalate through OMHA if you're denied. Finally, manage your future income so it stays below the IRMAA thresholds and you never pay the surcharge again. If your income has dropped and you're still seeing an IRMAA surcharge, don't wait. Every month you delay is money you can't fully get back. Next, I'm covering how to time Roth conversions in retirement, so you don't accidentally trigger IRMAA 2 years later, which is the exact trap that catches people right after they win their appeal. If you want to catch that one, subscribe so you don't miss it.